Bloomberg Audio Studios.
Podcasts, radio, news.
It is a very big week of economic news, and just a few of the highlights include that CPI report, the latest Fed decision on Wednesday. We're also going to keep an eye on producer prices and jobless claims on Thursday. Let's get some insight on what it all means for the bond market. Joining us is the bond king himself, Bill Gross, co-founder of PIMCO. Bill, it's our launch day. It's our first show on the new set. We relaunched. We super appreciate it. Joining us on launch day, Bill. Thank you so much.
You're welcome. Good to be here.
All right, what's the trade into the Fed on Wednesday? What do you think?
Well, I don't think there's much of a trade on treasuries. You know, to my way of thinking, the 10-year, which is close to 4.5%, let's call it 4.5%, is dependent upon inflation, which we'll see on Wednesday, and we'll know more because of that. But if inflation is 2%, I think the 10-year belongs close to 4%. If it's 3%, it belongs closer to 5%, and we're right in the middle. So at the moment, with 4.5% 10-year treasuries and break-evens at around 220, you know, that's a 470 basically break-even for the nominal 10-year treasury, and I think we're about there. There's not much to be done until we know more.
Bill, what are the chances that we see, say, the median dot in 2024 and 2025 actually move higher? I mean, do you think there's a possibility, and what would be the reaction to something like that?
Well, I think it would be negative. You know, the Fed has basically signaled they're sort of done, perhaps 95% done in terms of raising rates. It's not that they can't raise them if the print on CPI isn't bad for the next several months, but you know, I think the market basically anticipates the Fed to stay, and maybe in September, maybe in December, maybe one or two cuts if, you know, the current numbers continue as we've seen them.
I am curious, Bill, when we talk about all the moves that we've been seeing in the bond market as of late, particularly in treasuries, as people try to sort of game what the Fed does next, is there still a strong correlation between what we're seeing there and what we're seeing in the equity market, or is that kind of splintered?
Yeah, I don't think it exists anymore. I mean, for years, I've followed the correlation between the two, between real interest rates and stock prices, between the Fed funds rate and stock prices. And, you know, as we've seen, you know, the Fed raised their short-term rates over the past year and a half or two from close to 0 to now 5 3/8, and the stock market basically has neglected all of that in terms of the rise in not only nominal but real interest rates. So, you know, the correlation is broke down. It's more of a momentum type of market. Actually, it's a very momentum-driven market with AI that you've just talked about. And so I wouldn't be so keen, I guess, on correlating stock prices to interest rates at the moment, at least.
When you look at valuations around here, and I know you can sort of look at this market, either you could go the traditional bottom-up valuation method or just, I guess, look at the technicals and ride the momentum. But when you look at valuations and all the arguments right now that this market might be overvalued, things might be overpriced here, do you find, I guess, credence to that?
Oh, I think so. I mean, it depends upon which multiple, which PE multiple you use, whether it's the 10-year CAPE, as they call it, or whether it's the immediate expectation for the next 12 months. In any case, it's historically high or close to historically high at 21, 22 times for a PE. And so to my way of thinking, if the economy slows, and I think it's slowing, we don't need a recession, but if the economy slows and earnings growth fails to meet expectations, I think there's a problem in terms of valuation at the moment for many stocks.
Many stocks. Well, does that mean, like right now, based on at least what we know publicly, would you be comfortable taking a broad market position right now in U.S. equities?
No, but I'd be comfortable in taking a specific, bet and investment in certain areas which are still very attractive. I know that's the standard explanation that investors basically say, but I think there's some areas in the market that are very attractive based upon a slowing economy and based upon high valuations in many stocks.
Where,
the
Bill?
S&P
Where?
And the NASDAQ. Well, let's talk about a few. I've owned for a long time and have recommended for a long time master limited partnerships for pipelines. These are stocks, these are partnerships, and because of that, they can't be bought by basically by the market, by mutual funds, and so it's a narrow universe. These are stocks like Energy Transfer, ET is a symbol, like MPLX, Marathon Pipeline, which is the symbol there. They yield between 8 and 8.5%. And there's one that I love, I actually love, WES Western Pipeline yields about 9.5%. These yields are basically utility yields. They're take-or-pay type of contracts. They defer, because they're partnerships, they defer taxes on their dividends. And so it's a huge, it's a huge attraction to me in terms of yield and potential price appreciation, and they're all close to the top of their 12-month highs.
Along the same lines, you mentioned utilities. Utilities continue to sort of outperform, and a large part of that are their power players like Vistra or Constellation Energy, and that's definitely related to the AI play. Do you buy into that kind of hype?
Yeah, I think so. I own some NEE, which is the Next Energy, and I think there's a correlation there between interest rates and between the price of the stock. So I think in certain areas, I think utilities as a whole have sort of been overblown in terms of their move relative to AI, artificial intelligence, and the fact that they use more energy. But there are certain stocks there. NEE is one of them that I like.
What about banks right now, Bill? There's been a lot of talk here about financials and this idea that quite a few of them might actually sort of have been kind of valued, maybe not appropriately. The idea that there's a little bit more juice left in some of those names. Do you find any real value there, particularly outside of just the big money center banks?
Yeah, I've bought some regionals today, and I do think they're down 10 or 15% from their peaks, and so that's one positive going forward. Many of them yield 5 to 5.5%. I bought this morning, KeyBank, KEY, yields close to 6%, and it seems to me that the commercial real estate problem has been reserved against for the most part, and so KEY or Truist TFC or Citizens CFG, to my way of thinking, are very attractive investments for the immediate to long term.
I am curious on the point, though, of commercial real estate. There's been so much hand-wringing right now about the next shoe to drop, the idea that we haven't really worked ourselves through the CRE crisis or whatever we want to call it here. You're not worried that we're going to see any sort of major defaults, or at least not major enough that it would really rattle the market?
Well, I think it's dependent upon the economy. If we get a decent recession, then obviously commercial real estate loans are less attractive than they are at the moment. So watch the economy. As I pointed out before, I think in many cases these regionals have had a year or 2 years to reserve against the potential for additional losses. It's just, they traded PEs around 9. They traded price to book values of 0.7 or 0.8 relative to something like JPM. And so, I like them for the long term.
Hey, Bill, one of the big news items that really moved markets over the last 24 hours is what we saw over with the parliamentary elections and Macron calling for legislative elections at the end of June, early July. The market moved quite sturdily here. The euro hit a 1-month low. You got a pop in yields. The BTP Bund spread really blew out. You got a weakness in the equity market over in France in particular. What did you make of the market reaction to what we saw?
Well, I think it's to be expected. I think in terms of an attraction, German 10-year bunds and French oats, the 10-year there, their spreads have narrowed significantly in the past month or two relative to treasuries, and today as well by 8 or 10 basis points. So there's coming a point where European bonds are more attractive than treasury bonds, in my opinion.
Where? What European bonds would you be looking at, Bill?
Well, I mentioned 10-year bunds, 10-year oats, Italian bonds as well has gained more attraction in the past several weeks, and certainly after last night's snap election in France.
And it's interesting too, Bill, because we talk about what happened overnight with the EU elections and the snap election in France coming up. We also had 3 elections, of course, in India, and Mexico, and a couple other places, South Africa, that also rattled investors. And of course, as you know, we still have a big election here in the U.S. that could have a dramatic impact on investor psyches. Are those, at least here in the U.S., as we move forward to November, do you think that is going to be a tradable event? Do you think that the policy differences and the reaction to whoever wins in November will be market moving?
Yeah, I think so. And in these cases that you mentioned, these prior elections in the last few weeks, they've all moved right, and there's a certain consequence to that. But there's also an element of uncertainty, and so what we've seen, last night and what we've seen in the last few weeks is a reaction to uncertainty in terms of not only the party that's dominating, but uncertainty in terms of what their policies will be. And I think as we move to November and something becomes more clear in terms of who might or who might not win, the uncertainty plus the potential policy implications, I think, could impact treasuries significantly.
Yeah, it's going to be interesting to see your next investment outlook post-election to see what you have to say there. And it's interesting, too, how you've compiled all of your past investment outlooks into a new book. One thing that I didn't really see in there, and that maybe you'll have to do in an updated book, is maybe have a little bit more discussion about AI and what that means for the market as a whole. When you look at all the AI hype around here, the run-up in NVIDIA, do you find any sort of opportunity there that's to your liking? Do you think it's sustainable?
Well, I'm not a pro there, but I would say that AI, to my way of thinking, has the potential to increase productivity in general across the U.S. economy. The question is by how much, or if at all. To the extent that it even increases productivity by 0.5%, I think it's significant in terms of economic growth. So, that's the bet. Specific stocks, I like Microsoft. I've never been involved with NVIDIA or Amazon or even Apple today, for instance. But Microsoft is my favorite. Other than that, it's a wait and watch type of situation in terms of the impact on economic growth.
So, Bill, not only is it the launch of our new show, but also you will be selling piece by piece a U.S. stamp collection on Friday and Saturday at Robert A. Siegel Auction House. Now, you've sold your stamps before. You are clearly a very well-known collector. Some of the estimates, though, think this could bring in a record of something like $20 million. Bill, what told you that this was the right time to sell in this kind of environment, these stamps?
Well, I'm 80 years old, and it's time to turn this over to some other future collectors. And I also think, a slight negative here is that stamp collecting has always been a function of kids and their collecting who later on become adults and, wealthy adults. But in this case, I don't think the kids are collecting stamps anymore. They're more involved with their cell phones and their games, but that'd be one of the reasons too.
Well, I could tell you, Bill, there are still a few nerdy kids out there that are still into it. I know a couple in my family that still do it. I don't think they're in the market for the stamps that you're selling. They're pretty pricey here. But I was just looking through this is just an impressive collection. Obviously, probably the star of that, of course, is one of the inverted Jennies. But I am curious, when you look at just the collection that you had and how you put them together here, was that really from the heart? Did you sort of look at this and just say, oh, this will be a good deal later? Or did you say, look, I just want to own this and I want a piece of this and I want to be able to hold it and look at it?
No, my mother back in the 40s and the early 50s collected stamps in order to send me to college. I took those stamps to San Francisco in 1961 and tried to sell them. They'd offer me nothing relative to the 3% on the face of the stamp. So basically, when I had some money 20 years ago, I said, she had the right idea, but she bought the wrong stamps. And so if I can apply bond market economic terminology and philosophy to the stamp auction, much like paintings have a provenance and so on, then perhaps we can make some money as well.
All right, Bill, always great to talk to you, and good luck on that auction later this week. Bill Gross, the co-founder of PIMCO, the Bond King.